Hello, everyone, and welcome to Dollars and Cents, Decoding the Insurance Profits Puzzle. My name is Ashley Healy, and I am a P&C Insurance Advisor on the Protect team here at SignatureFD, and I will be your moderator today, and thank you all for being here. I want to tell you a little bit first about our discussion leaders for this afternoon. First up, we have Maria McCool. Maria McCool is a partner at SignatureFD, and she oversees the firm's property and casualty insurance agency. She has over 35 years of experience as a consumer, a carrier representative, and agent, using that experience to help clients navigate their insurance buying decisions in the broader picture of risk management, cost containment, and asset protection. Thank you for being here, Maria.
Thank you.
Next up, we have Josh Esterov. Josh is a senior director and head of U.S. insurance at CreditSights, a leading independent fixed income research institution. His responsibilities include coverage of the property and casualty, life, and health insurance sectors. Josh is a CFA charter holder and has an MBA from New York University and completed his undergraduate studies at Rutgers University. Welcome, Josh. And then finally, we have James Pozzi. James is a graduate of Fairfield University with degrees in mathematics and economics, holding the Chartered Financial Analyst CFA designation. James has devoted his professional career to various functions within the high net worth personal lines insurance niche, covering underwriting, claims, marketing, strategy, and finance at Pure Insurance. Welcome, James.
Be here, Ashley. Thank you.
We were having a share issue, so she's pulling up. There's what we're supposed to be seeing. Welcome, everybody, and thank you so much, all three speakers being here today. Before we begin the discussion, I want to take a little bit of a look at the topics that we're going to cover. Up first, one second. There we go. We're going to have opening remarks on industry profitability and premium increases. We're going to talk about the impacts of credit rating downgrades on the larger insurance companies. We're going to talk about factors that are affecting insurance industry predictions. And finally, we're going to talk about guidance for our insurance renewals for consumers. We'll wrap it up with a Q&A session. For during the whole presentation that we're doing today, you can, at the very bottom of your screen, in order to do a question, you'll click on the Q&A button that's at the bottom of your Zoom window, type your question in the box, and then click send to submit your question. And you're welcome to do that throughout the whole presentation. And then at the end, we'll do our best to address as many questions as possible. And thank you all for participating. So let's get started. Josh, up first, we're going to begin with you.
Very good.
Welcome, Josh. Okay, so Josh, you were recently quoted in a Wall Street Journal article, and the title was "Insurers Rake in Profits as Customers Pay Soaring Premiums." SignatureFD can confirm that our clients are seeing soaring premiums, as every single one of our carriers are communicating profitability issues. Is it possible for these two opposing statements to both be true?
Yeah, good question. And hello, everyone. And just quickly, thank you to the SignatureFD team for inviting me, and the Pure Insurance team for joining me. But back to business and back to the question. I think it's a really good question to start off with, because while you're correct that I was quoted in an article titled "Insurers Rake in Profits," I'm not sure that I necessarily agree with the author's conclusion. So while I think it's very true that insurers focused on business coverage have been performing extremely well, I think really the exact opposite is true if I'm limiting my commentary to retail, auto, and home insurers. So just by way of example, insurers reported paying out about $1.12 and $1.05 for every dollar in premiums collected in 2022 and 2023, respectively. And so I think it's fairly straightforward that when insurers are paying out way more in claims than they're collecting in premiums, it's difficult to argue that they're really raking in profit. So that kind of naturally leads into the second part of your question, which is, why is everyone paying soaring insurance prices for their cars and homes? And so I think we kind of need to set the table a bit to really answer that question. So I'm going to put up a slide here, and this chart is measuring what's known as the industry's combined ratio in personal auto, or basically the percentage of claims paid versus premiums collected. So the lower the ratio / percentage, the more profitable the insurer. So we've kind of got this baseline here with 2018 and 2019. But when we go back to 2020 and the start of pandemic conditions, it's genuinely true that retail auto insurers really were raking it in because everyone stopped driving. We all got locked down, and nationwide miles driven just fell off a cliff for a period of time. And in fact, some insurers responded by even giving premiums back to policyholders. And I really can't think of another moment in time the industry did so well that it voluntarily gave back premiums. That was really an unprecedented period of profitability. And insurers actually lowered prices to account for that new driving pattern. But then lurking right behind that, inflation kicked in, and inflation hit the auto, and by extension, the auto insurance sector particularly acutely. And many of you can probably remember that period of time where used car prices started soaring, and like all of a sudden driving your new or used car off a lot meant you might be turning a profit. But in addition to that, think things like vehicle part replacement costs, labor costs, supply chain shortages, to some extent even unfavorable litigation trends. Think things like more ambulance chasing and the like from lawyers. All that contributed and combined to rapidly move the industry from this period of unprecedented profitability to unprecedented losses. So like I mentioned earlier, 22 and 23 transition to some of the industry's weakest years from a profitability perspective in recent memory. And then in the homeowner space, repair costs just started skyrocketing too. And that period of intense demand for suburban homes didn't help either. There's also been some unusual weather patterns and severe storm activity across the country that contributed to some outsized losses for insurers participating in the homeowners business in recent years, and that also hasn't helped. But so of course, given these profitability challenges, insurers pulled on the levers they had available to them, and first and foremost, price increases. But price increases take time. You need regulatory approval across individual state geographies, and then you got to wait for policyholders' existing policies to mature. Then you have to sell a customer a higher cost policy, and so on. And meanwhile, inflation just kind of keeps on keeping on. So we entered the cycle of insurers raising price to try to catch up for inflation, and then raising price again to account for even more inflation. And you may have noticed, when you turn on a football game or something, there were suddenly fewer insurance advertisements. That was another lever insurers were pulling. They suddenly didn't want new customers coming on board until they could get their pricing sorted out.
Okay, so James, turning to you, Josh mentioned a lag of an insurance company's ability to increase rates because of regulatory approval. Can you talk a little bit about the relationship between the departments of insurance in each state and how those affect a carrier's ability to obtain the rates that they need in a timely manner?
It's a great question, and insurance regulators play a vital role in the industry. Certainly, the relationship between insurance carriers and the state departments of insurance is crucial and can significantly impact the carrier's ability to operate efficiently. So each state has its own regulatory body that oversees insurance practices. One of those responsibilities is ensuring that rates or prices are fair and justified while protecting consumers. However, this regulatory environment can sometimes lead to delays in rate approvals due to rigorous review processes. Insurance carriers must submit detailed justifications for rate changes, which are scrutinized to prevent unjustified premium hikes. And that's a good thing that protects consumers, but it can also hinder carriers' ability to adjust rates swiftly in response to emerging risks or increased loss costs. And if a carrier can't charge an adequate rate relative to costs they incur, like that over 100% ratio Josh just highlighted, they are incentivized to no longer issue new or renewing policies, at least not until the point they get prices in the right place. And this, in turn, is certainly happening in the industry, especially in markets like California, Florida, and others that experience high weather activity like hurricanes and earthquakes. So this is creating not only an affordability crisis, but the delay in carriers' ability to increase rates is actually causing an availability crisis of insurance in some key markets out there in the US.
Okay, and so Josh, to James's point, there's an availability crisis of insurance, and companies like State Farm are limiting new policies in states like California and Florida. A recent article in Insurance Business announced the credit rating downgrade for State Farm with the tagline, AM Best has knocked down the insurer's financial strength rating due to a weak balance sheet. The NAIC estimates State Farm's market share in the US to be 18.4%. The article cites their losses and a declining surplus as the reasons for the change. What is the impact to the insurance industry when a player as large as State Farm is struggling?
Yes, I'd say State Farm is actually a really good illustrative example of the challenge for the industry. So like I had mentioned earlier, insurers at one point, they actually gave back premiums, lowered pricing, and then they got kind of caught off guard by inflationary cost trends. State Farm, much like the rest of the industry. And what's a little bit tougher for State Farm is they are the nation's leading auto insurer with a leading market share across geographies, and including some of those geographies, like James just mentioned, like California, where regulators were either particularly averse to authorizing price increases, or state law made it more difficult to obtain price increases, and even worse in some states, it was both at the same time, especially like California, for example. But anyway, with steep losses, State Farm saw their capital levels decline. And I'm not going to get into like the nitty gritty regulatory accounting, but basically surplus is a regulatory accounting line item that's kind of similar to shareholders' equity if you're reviewing a publicly traded company. And this led to some negative credit ratings action at AM Best at one of their operating companies, for example. But they're by far not the only ones in a similar boat. For example, Allstate, another industry leader, they were just bleeding capital for a couple of years. The regulatory capital hit a high water mark of north of about $20 billion at year end 21. And that fell all the way down to $13.5 billion midway through 2023. So they lost about a third of the regulatory capital in about a year and a half. They saw downgrades from rating agencies as well. And that only further raised the urgency to raise price and restore underwriting profitability as soon as possible. So to kind of circle back and answer what the industry impact was. Well, if I'm going to strictly limit my discussion of the credit rating aspect, that impact was actually kind of marginal. There really weren't significant operational impacts from the rating agency downgrades. And actually, for better or worse, once an insurer is downgraded, it reevaluates whether or not it needs those higher ratings in the first place. And higher ratings often require that insurer to hold more capital, which could be considered inefficient from a shareholder's perspective. But actually, I think net at the end of the day, to the consumer and the industry, very limited impact from the ratings downgrades, but it definitely did add further added urgency to get price increases across the board as quickly and with as much magnitude as possible.
Well, Josh, I don't think any of us want to hear about urgency for price increases.
I'm just a beacon of good news.
Right, we appreciate that. You're certainly painting a picture, though, of why the insurers feel that this price increase is necessary. And you've both mentioned inflation being a factor. James, can you talk a little bit about inflation and also reinsurance and how both have an impact on carrier profitability?
So inflation and reinsurance are both playing a critical role in affecting a carrier's profitability. So first, starting with inflation, after the global economic shutdown in response to the pandemic and an influx of stimulus packages, we as consumers have seen inflation rise everywhere across industries. And this certainly is showing up in insurance as the cost of claims increased with prices for materials, labor, and services rose. The chart in the upper right corner highlights the price increases for hospital and medical services, which drives up the cost in severe car accidents or insurance claims where bodily injury may have occurred. And certainly in our own data, we're seeing large increases in the cost to repair damaged vehicles, as well as those cars are staying in shops longer due to delays in part deliveries, which means longer rental days and higher costs for those rentals. So it's hitting us on all sides, and ultimately the same loss event costs much more today than it did years ago, putting pressure on overall profitability. And now we're seeing carriers increase premiums to these rising costs across the industry. You also mentioned reinsurance. Reinsurance it helps mitigate a carrier's highest risk by providing additional financial protection, primarily against large or catastrophic losses like hurricanes. It does come at a cost to the primary carrier. However, the cost of reinsurance itself has been rising significantly, partly due to the increase in frequency and severity of natural disasters, as well as inflation that they're seeing on everyday claims or during a weather event. So the rise in reinsurance costs squeezes the carrier profitability, and they don't have the state regulatories overseeing their pricing structure. So home insurance carriers saw reinsurance increase swiftly by 50% over the last 2 years. Comparatively, carriers can't increase prices nearly as fast, despite what some policyholders may be experiencing. So this has amplified the lack of insurance availability in heavy cat markets where reinsurance is really important to protect against perils like hurricanes. And it's a hard market, and one which carriers need to be thoughtful of their decisions, which is why Pure is selective and thoughtful on welcoming the most responsible members of the finest built homes into our membership. It's interesting times for sure.
It's certainly interesting times, and interesting to hear that insurance companies are also having to pay more for their insurance in the reinsurance market. Josh, here at SignatureFD, we saw carriers increasing rates to address profitability in 2023, and we're seeing it again now so far in 2024. How long do we expect this current environment to last before the financials have healed for the insurance companies?
Yes, I think the industry in aggregate it has probably reached an inflection point whereby losses are narrowing, and that's coming after the implementation of all these significant premium rate increases. But just to throw out some examples and reference points out there with names folks on this call might be familiar with. We're looking again at insurer combined ratio. So remember, lower is better, means an insurer is paying less in claims than it collects in premiums. And we sampled 7 insurers here. Every one of them reported significantly stronger financial performance in the first quarter of 2024 relative to even just 1 year ago. So a couple examples. Allstate, they just reported a second consecutive quarter of underwriting gains in their personal auto business, and that was after 9 consecutive quarters of underwriting losses. Travelers just reported its first underwriting gain in personal auto for the first time since early 2022. And Progressive, they've actually kind of been the industry outlier in some cases. From the perspective of their shareholders, they've actually kind of been crushing it. They've been profitable since about mid 2023, and we can get into the details of that if folks are interested, maybe in Q&A. But maybe insurers did benefit from somewhat favorable driving conditions in the first quarter of 2024, but and regardless, like profit improvement isn't yet ubiquitous quite across the entire industry. For example, I can point to Hartford. They posted their 8th consecutive quarter of underwriting losses, but even in that case, they've narrowed the losses down to about minus 4% per dollar collected from minus 10% per dollar collected a year ago. And so I think for most of the industry, we'll probably need another year, give or take a couple of quarters, before the vast majority of the industry really feels like it's on firm footing with regards to their profitability. At this point, though, I think it's likely that only a handful of geographies, so hopefully not a ton of folks in this call are living in places like California, New York, and New Jersey, where significant rate increases are still necessary, and those states are really preventing a more rapid recovery across auto insurance books of business. And even though regulators in these states are now allowing sizable rate increases, it's probably only bringing insurers closer to break-even levels in these states. So probably a lot more to come if you live there. And I'll use Allstate again as an example. They just recently got approval for a 20% increase in New Jersey. That was late last year, and now they filed for another 14% this year. But even with that, and I'm kind of paraphrasing their management team here, we're still going to need more rate beyond that. And so I think broadly speaking, insurers are probably feeling cautious optimism about where their pricing is at the moment, in probably like 80% of their geographies, of their states. So point being, I think approvals for the most significant rate increases across most geographies are probably in the rear view mirror, pun intended, at this point, as the industry is starting to get ahead of these cost trends. And going forward, I think most price increases should be more modest in nature, but perhaps the next policy renewal for some folks, that could still come with some sticker shock. And maybe the silver lining here is the next one after that will almost certainly be more modest in nature.
I guess in the current market, modest in nature is a silver lining and is somewhat good news. So James, you work with PURE, which stands for Privileged Underwriters Reciprocal Exchange. Can you speak a little bit about the reciprocal exchange model and how it is functionally different from a stock insurance carrier?
So the model of an insurance company is very important on what stakeholders are driving business decisions. So let's do this by following the dollar of premium. a fair amount of premium goes toward claims or back to a select number of unfortunate policyholders to make them whole again after a loss event. And some of the premiums paid for expenses or to fund the operations to actually run the business. But what if premiums are greater than both losses and expenses? Well, then you have underwriting profit. And it's going to depend on the structure of the carrier. So pure is a reciprocal exchange, and the policyholders themselves actually own the company, forming a mutual insurance structure. This means that any profits are reinvested either into the company that they own or returned to the policyholders, aligning the interests of the insured with the insurance company. In contrast, a stock insurance carrier is owned by shareholders or Wall Street. Their primary obligation of a stock carrier, like any publicly traded company, is to maximize shareholder value, which can sometimes create a divergence between the interests of the shareholders and the consumers or policyholders. For example, if the carrier increases rates and prices beyond the costs they incur to generate more profit, that money goes to Wall Street in the form of dividends or stock buybacks, which we're seeing a rise in, versus a reciprocal where we allocate that money back to policyholders. And in fact, we have allocated more than $115 million back to policyholders. And we do this on an annual basis relative to prior year's performance. So if we collect more premium than gets paid out to claims to those members, it goes back to the membership based on the amount that they paid into it in that year. So the reciprocal model fosters a much more member-centric approach, often leading to higher levels of consumer service and satisfaction, as the policyholders are the primary stakeholder.
Okay, and so James, our next question is also for you. Insurance is predicated off of actuarial data from weather patterns for the last 200 years. What has changed that has affected performance as well as our ability to predict?
Yeah, it's a great question. Certainly costs have rose significantly from inflation, where prices need to catch up. But we use historical actuarial data, as well as predictive catastrophe models to predict risks and set premiums accurately. However, several significant changes have impacted our ability collectively as an industry to do this more reliably than in the past. And that's mainly driven by climate change, which has introduced new variables or changing variables into weather patterns, making historical data less reliable. So for example, we're seeing warmer ocean temperatures that is creating more powerful storms. And to highlight this point, the scientific definition of a rapid intensification of a hurricane is an increase in sustained wind speeds of 35 miles per hour in a 24-hour window. Hurricane Ida, which occurred just a couple of years ago, did that in 6 hours alone. And Hurricane Otis that rocked Mexico just last year had an increase within a 24-hour window of 110 miles per hour. It's being coined the surprise hurricane. We haven't seen these development patterns in decades past, and patterns like this make it much more challenging to protect property, batten down the hatches, as well as evacuate when that storm is on its way. But I would say the bigger factor that's on the rise than hurricanes is what the industry is referring to as secondary perils. It's not the hurricanes or the earthquakes that are the main natural perils that are driving up weather costs, but simply thunderstorms. The U.S. National Oceanic and Atmospheric Administration, the mouthful, or NOAA, has reported a total of 8 thunderstorms that amounted to $1 billion in the decade of the 1980s, eight events in 10 years. However, there have been 67 in the past 5 years, and this is adjusted for inflation. So storms are becoming more frequent and more severe. Just last week, Texas believes they found a record-breaking hailstone size. The size was literally the size of a pineapple falling from the sky. And there's also a rise in other secondary perils, such as fires in the West, with wildfires in California and other Western states destroying more homes, as well as winter storms, such as the one in northern Texas 2 years ago. So the industry is working to better understand the rise of these secondary perils and provide insurance at both a fair price, yet appropriate to the rising risks.
It is definitely an interesting time. I think that for all of us, when it really hits home, though, is when we open our insurance bills. Maria, since you work directly with insurance customers, what are you telling clients to expect when their insurance is getting ready to renew?
Okay, that is a great question, Ashley. But before I answer that, I do want to say a big fat thank you to both James and Josh for your willingness to participate in this webcast. I know you have full-time jobs and all this did was put more on your plate, but your participation has been invaluable, and your willingness to come alongside us on what I think is really timely and important topic is much appreciated. So the question, what should we expect when we open our renewal bills? Well, what I'm telling my clients is you really are going to need to gird your loins when that bill comes in the mail. It is going to be a bit of a rough ride. In preparation for this webcast, I looked at 2023, the renewal premiums that my clients paid in the first quarter of 2023 across all my carriers. And then I compared that to the renewal premiums in the first quarter of 2024 for all my carriers to see what that differential was. And I took out any lost business and I took out any new business. So I was really just comparing the renewals in the first quarter to the renewals in this first quarter of 2024. And what I saw across all that group was basically a 35% increase. And that is kind of stunning. It's real money. And I'm not just an insurance agent. I'm actually also an insurance consumer. Because I work in the insurance industry, I do not get free insurance. Although, James, that's an excellent idea and something Pure should consider, really. Put that on the list. But I do think that what is going on is why you're hearing so much in the news about how insurance renewals and premiums are having a broader impact on the economy and inflation as a whole. And, you know, just looking at some recent articles, you will see one that I saw recently said that the average premium to insure a vehicle in Georgia is $2,600. That's the average. The article that you see here from CNBC on the screen said that skyrocketing auto insurance costs help contribute to inflation accelerating at a faster than expected pace in March. And a recent Bloomberg article points to the fact that the Consumer Price Index, which is a key metric of inflation, does not include in the calculation of CPI, it does not include insurance premiums. If it were to be included, it would have increased the CPI increase for 2023, which was 3.4%, to almost 4.2%. So it's going to be a bit of a tough year as we get through 2024. But as Josh said, I think we're going to see some easing of that as we head into 2025.
Well, I do like the idea about just no more insurance increases or costs from James. Let's work on that.
Yep.
But James, can you talk a little bit about how Pure is using technology to lower the your loss ratio and improve results? And hopefully this is going to trickle down a little bit to the rest of us.
It's a great segue. I don't know if we'll ever get to $0 insurance policies, but what we're trying to do is reduce the cost of insurance, and that really comes to reducing the likelihood of losses occurring. So at Pure, we leverage advanced technology in many facets of our business, but no more importantly than doing just that, of enhancing our risk management capabilities and making our members' homes more resilient and mitigating those losses. So our technology-driven approach is deeply collaborative. We partner closely with our members, providing them with tools and insights to help prevent losses. For example, we offer personalized in-person risk management advice and resources to help them safeguard their properties. We recently implemented a new loss prevention device to members, which monitors the electrical currents in their homes and alerts homeowners of abnormalities before they can lead to electrical fires. And the cost of this program is actually incurred by us to protect the member's home. It was smart return on investment for us, and it's protecting the lives of our members and reducing those losses ever occurring, lowering the pressure to increase premium. And we've had dozens of saves already since introducing this program, so we're very excited for it. We've also created the Pure Home Spotlight report, which is free for members that are purchasing their next home. They can run the report to see if that home that they're looking to purchase, how insurable is it to different perils, if there were prior claims or permits that happened on that property, to make them smarter in that purchasing decision. Also, a key component of our risk management strategy is the Pure Situation Room, which continuously monitors weather patterns as well as fire outbreaks across the map. And we actually deploy real-life resources proactively to mitigate potential fire losses during wildfire events. We hire, like firefighters to actually go out to those homes and prevent the structure for actually catching fire. It's quite heroic, and it's something that we really believe in. So by harnessing technology and fostering strong partnerships with our members, bringing them along the journey, we not only lower our loss ratio by preventing and mitigating risk, but we also enhance the customer experience. If a loss doesn't occur, their day-to-day life is not interrupted by a major event. So this comprehensive strategy is important to us. We're going to continue to invest in it, and it provides exceptional value and service to our policyholders, making insurance more transparent and responsive to their needs.
Okay, and so Maria, James is talking about things that Pure is doing to mitigate and control losses overall. Can you speak to water damage claims and how they have impacted your instructions to clients about reporting claims and your ability to place coverage if there has been a claim?
Absolutely. Honestly, water damage claims have really become the nemesis of the insurance industry. Water damage claims account for 1 in 5 of the insurance claims that are submitted, and annually it's amounts to over $2 billion in damages. And this is water damage not related to floods. Floods is a separate issue. This is a water damage claim within your home. And the number of claims has been rising, and the cost of those claims has been rising for some of the reasons that we've already discussed previously, inflation, et cetera. Additionally, more people are living in homes with more appliances. So my client base tends to be high net worth individuals. And frequently now in new homes, you have the kitchen and then you have the galley kitchen or the back kitchen, which means you have an additional refrigerator, an additional sink, an additional dishwasher, all which provide additional opportunities to leak within the home. And there's a lot of things that can cause a water damage claim. Frozen pipes, high pressure within your home, corrosion, cracked seals, broken pipes, any of those can lead to a water damage claim. And for those reasons, carriers are becoming much pickier about who they will insure for new business. They tend to believe that the prior claims are the biggest determinant of whether or not someone will have future claims. So why is this important to you? If you are purchasing a new home, and you go and you want to get it insured, and the prior owner had a water damage claim, most of my carriers now will not insure a home that has had a prior water damage claim unless one of these loss prevention water shutoff devices is installed within the home to prevent a future claim. Now, these devices cost probably somewhere between $2,500 and $5,000 when you consider the cost of the device and the installation. And so if you are going to have to install one of these in order to obtain insurance on your new home, understanding this and knowing this on the front side when you're negotiating the cost of that home could be a very helpful piece of information. I also am very much cautioning clients on submitting water damage claims at all. So let's say, for example, someone has a $2,500 deductible on their policy and they have a water damage claim, small leak in a bathroom, but it's going to require that they have the hardwoods replaced in that bathroom. Let's say it's going to be $5,000 or so to actually repair the loss, the claim. I'm going to tell them, don't submit that claim, even though it is a covered claim under the policy. And because of the impacts, the broader impacts of having submitted a water damage claim. So if you're going to do that, then I'm going to recommend that you consider taking higher deductibles on the front end so that you can actually reap the premium savings that higher deductibles provide. So rather than take a $2,500 deductible, take a $5,000 deductible on the front side. And then sort of my last Heloise hint on this whole subject of water damage claims is there are some real simple things that you can do within your home to help mitigate the potential for a claim. So the first one is really easy, and you'll see it here on the screen, that this connection between the toilet and the pipe going into the wall is a plastic connection. They are simply not as durable and crack easily. So very easily upgrading from the plastic to the metal option is easy and not expensive change to make. Another example, if you have rubber hoses on the backside of your washing machine, go ahead and trade those out for the steel braided hoses. Not expensive, not hard to do, but very impactful as to whether or not you might actually have a claim. And we've talked a good bit about the cost of having a claim, but what we haven't really talked about is the pain in the backside factor of having a claim. Because if you have to have all of the hardwoods in your home replaced because of a water damage claim, that means that you have to have all your furniture taken out. You have to deal with contractors coming in and out of the home. You have to probably move outside of the home while the work is being done. It's really, really not fun. And while the insurance company does pay to have this work done, you are the person who's having to meet contractors and go through all the effort to make sure that the work gets done. So anything like this, simple stuff like this that you can do to help reduce that risk is better for all.
So you're talking about property claims, which I think we all are somewhat familiar with, but it's helpful to hear, different things we can do to mitigate that risk. Can you also talk a little bit about the increase in liability claims and why it is critical in your recommendations to clients right now?
Absolutely. So this is probably the biggest concern that I have for my clients because I think it is probably the most significant threat to their assets. And that's what we're about, is making sure they're well protected. We're in a bit of a liability crisis right now in the United States. The personal injury industry, which is measured in revenue in 2023, was $60 billion. It used to be that if you had a car accident and you hit somebody, your insurance company paid to fix their vehicle. If their arm was broken, they'd pay their medical bills to get their arm fixed, and everybody just kind of went on about their way. Now, those type claims, the individual is typically represented by an attorney. And what we know about that is that 70% of the people who file a personal injury claim receive a payout, which could be either an out-of-court settlement or it could be award after trial. The most common personal injury claims are motor vehicle claims. So that could be a boat, it could be an RV, it could be your car. The second type of liability claim that people see are premises liability, right? So someone gets hurt at your home, or perhaps you host a party and someone gets intoxicated, leaves and hurts somebody else or hurts themselves. That would be a premises liability type claim. And then finally, dog bites. That's what we see the most of as well. We simply live in a more litigious society than we did previously. Additionally, when a claim goes to trial, we are seeing much larger awards. And one of the reasons that that's happening is that juries are granting awards for economic reasons to address social issues. And I kind of call this the Robin Hood mentality. And you're hearing more and more about it in the news, which is this concept of redistribution of wealth. Additionally, there has been the emergence of what is called third-party litigation funding. And what that is when a party completely unrelated to the lawsuit, and it's usually a hedge fund, invests in a plaintiff's case in exchange for a cut of the settlement. All of the above lead me to my mantra, which is everyone needs an umbrella policy to protect their wealth. If you have a good driving record, you can probably obtain a $5 million umbrella policy for somewhere between $1,000 to $1,500. My counsel to clients is that they purchase an umbrella limit that matches their net worth. When I have clients that are looking to trim insurance premiums, they will frequently say to me, do I need a $5 million umbrella? Why don't I just take a $3 million umbrella and try to save some money there? And I personally would rather see them self-insure all their jewelry than to take a lower umbrella limit. Because if they have $200,000 worth of jewelry in their home and someone breaks in and steals all their jewelry, we know exactly how much they're going to have to pay out of pocket in order to get that jewelry back. They're going to pay $200,000. If their teenager hits someone and seriously injures them, we have no idea what that could end up costing them from a defense cost perspective or from a settlement or a verdict perspective. So bang for the buck, an umbrella policy is one of the best ways that you can mitigate your risk from a liability perspective.
Well, Maria, I certainly drink that Kool-Aid. I definitely think that everyone needs to have an umbrella. And I think that you're explaining the whys of that, is very well for all of us. I think this is a great place to transition over to our Q&A session and see if anyone has had questions as we go through all that you guys have had to say. Just as a reminder to all of our attendees, you can use the Q&A feature at the bottom of your screen to ask your questions. There's a little Q&A button on the bottom of your Zoom. Type in your question, and then you can click send to submit your question. And we're going to do our best to address as many questions as possible for the remainder of our time. The first question that we have, I think, is going to probably be a good one for Josh. Josh, the question is, if I have my insurance with State Farm or Allstate, should I be worried about their ability to pay claims?
Yeah, I think I wouldn't be at all worried about the claims paying ability at a company like State Farm or Allstate. If there was no line of sight whatsoever with regards to insurer profitability improving, that would be a very different story. But for insurers of that caliber, I think you're probably in good shape. I think for the moment, insurer profitability challenges, they've largely been a story about consumers having to pay higher prices and stockholders having to suffer through a period of lower returns. There have been some failures of insurers, but these are almost all exclusively very small and single state or even single community types of enterprises. I mean, there might be a reason to be a little bit more worried if you were like a creditor in other parts of the enterprise, but policyholders, I think they're generally well protected, by regulators, whereby regulations don't let insurers use capital for purposes ahead of ensuring there are sufficient resources for policyholders. All that said, I do think it's important to evaluate the quality of your insurance company or prospective insurance company from a few different perspectives, including things like customer service, whether it's stock or a member-owned insurer, or whether it has strong ratings from agencies. But end of the day, State Farm and Allstate, I think if those are in your consideration set, you're probably in good shape.
Okay, that's good to hear and nice to understand because it's been some scary headlines of late. Another question coming in was, do insurance companies have other revenue streams outside of premiums and is risk regulated by states? James, do you think you could take that one?
Yeah, I can take that one. Do insurance companies have different revenue streams? I would say yes, they invest. So insurance companies sit on a lot of capital or money, which was referred to as surplus earlier. And that money's not sitting just in a bank account ready to get deployed by claims. So insurance companies invest that money in very conservative liquid assets, but it does generate some returns, and the higher the returns, the better for the insurance company, which means those returns can help pay for losses and rising costs and lower the pressure to increase premiums. So that's one. And then the second question was, so all the insurance market is regulated by states. So every state has their own regulatory body, director of insurance that, so every carrier needs to have 50 relationships, and those laws are broadly the same across states, but there's certainly differences, and the regulators do a really good job in protecting consumers and holding insurance carriers accountable. And for the most part, it's a really good structure. However, it does hinder carriers' ability to change prices or policies as fast as they want to, and that's where you can create an availability crisis like we're seeing in Florida or Louisiana.
Okay, thank you for that. And then Maria, this one's going to be a good question for you. Should we shop our insurance each year to keep the cost down, or is it best to just stick with what we have?
Great question. I will tell you, in this environment right now, I am encouraging clients to really stay with the carrier that they are currently with. And here is why. When a carrier writes you for new business, they will send someone out to appraise or inspect the property. Let's say you're with XYZ company and I market you to a different carrier, and we're going to save you $500 annually. You're like, okay, that sounds pretty good. I'll take that. We then place the coverage with the new carrier. They go out and inspect the home. And when they do that, they find a small drip or leak in the ceiling, below the toilet above. What that opens up from to you, as far as having to have a contractor come in and address that, because the carrier is going to say, in order for us to remain on this risk, you're going to have a licensed contractor come in, identify the leak, fix it, patch it, and do all that. Here's another thing that we have been seeing. Carriers are getting very, very picky about trees and the limbs that are overhanging the house. So we move somebody to a new carrier, they come out and inspect the house, they say, hey, you are going to need to trim all these limbs back off the roof line of this house for us to stay on the risk. And suddenly that $400 or $500 premium savings is completely eaten up by the cost to, have the limbs removed in your backyard. So in this environment right now, and with so many unknowns, I think it is absolutely best to kind of stay where you are, assuming that they will renew you and that it's just not unpalatable. Because, and this sounds like, I told this to my mom growing up, and it held no weight, but all the kids are doing it, literally all of the insurance companies are doing it. So I don't think you're gaining a lot by switching insurance companies right now, because they're all trying to get to the rate profitability line.
All the kids are definitely doing it.
They're all doing it.
For sure. Okay, so I think these would be for Josh or for James, I'm not really sure. There's much talk about premiums and increases. For many states, especially coastal counties, availability is more of an issue. Any relief in sight where carriers may come back into these difficult markets?
Hey, can
Yeah,
I
sure.
start? Can I
Sure.
start on that one? And then Josh, I'm not going to hit it. You come in and do the double punch.
Absolutely.
For me, okay. I was recently at an industry meeting, and the week before, Ashley and Phoebe, my team, all of y'all, the Wonder team, had been sort of bemoaning the current situation, like the not fun conversation. It's not been fun to have the kind of conversations that we've been having with clients at renewal. And we've been sort of, bemoaning that situation. And so I went to an industry event, and then I sat down at a table next to someone who is an agent in New Orleans and an agent in California and an agent in Florida. And after having sat through a conversation with those agents, I quickly ran to the phone and called Ashley and Phoebe and said, oh, good gobbledygoo, we need to be so grateful that we're not operating in these markets, because literally they have no options for their clients in numerous situations. I am a firm believer in, the free market, and that when carriers can make money, they will certainly re-enter and do that. But until that time, it is going to be a rough ride for states like California, Louisiana, and Florida. Josh, take it from there.
Sure. No, I think you've actually taken me right near the finish line. So maybe I'll just take another couple steps there. But in my seat as a credit analyst, I'm primarily interacting with like investors that are interested in like investing in the debt of insurance company X, Y, or Z. But the fact that I've actually had to publish material on insurance availability and affordability from the consumer's perspective speaks to how very real this issue is in certain geographies. But there can be differences between geographies in terms of their trajectory. In Florida, for example, that's a market that I categorize as being on a positive trajectory from an insurance availability and affordability and accessibility perspective. And a lot of that has to do with some recent legislative reform, in particular to account for some of these legal and litigation issues that Maria highlighted earlier. And in fact, there's even an industry jargon for this increased litigious society, and they call it social inflation. And in part because of high lawyer fees, for example, in Florida, the state-run insurer of last resort, which really is not designed to have significant market share in the state. In Florida, by the first half of 2023, it had about 22% market share in the state, and that's not really sustainable. So some recent legislative changes in Florida, for example, that reduce kind of the impact that litigation's having, and combine that with some increased access for insurers to find reinsurance solutions, which James talked about earlier. I think that's a market on a positive trajectory. But in contrast, California remains a very difficult market. There's disincentives for insurers to even try to get premium rate increases. It takes a long time. It has to go through a public hearing process. And now you've got the emergence of like wildfire risk. And don't quote me on this exact number, but something like 12 of the largest 20 carriers in Florida have either completely exited the state or restricted new business production, and that's really challenging. And I think California is a market that's kind of uncertain right now. There's a lot of folks out there in certain areas that are kind of uninsurable, and you either have to pay it kind of this outrageous price or go to the state-run insurer and get bare bones coverage. So very geographic specific, and whether it's a good story or bad story also depends on the location.
Okay, and I think we've got time for one last question. James, I think this one might be a good fit for you. Do you believe that carriers will start reducing or excluding coverage based on profitability?
Hi, great question. Sorry, I missed the last 2 minutes. My laptop died on me and I had to get to a charging station. Yeah, and we're certainly seeing it. I don't think we're seeing as much as reducing coverage on renewal to renewal, but we're certainly seeing excluding coverage altogether through non-renewals. Carriers are exiting markets. I don't want to play the name game, but we're certainly seeing that in certain states, as well as carriers are going under, a lot of smaller carriers in Florida particularly. So I wouldn't expect to seeing reduced coverage upon your renewal, although that can occur if they remove certain coverage types. But we can certainly see more non-renewals occurring across policyholders, which is concerning, because then they have to find a new policy, and it's really challenging, as we've been hitting on with premium increases.
And I would just add one thing to that. I am seeing a lot of carriers really tightening up the wording in and around roof replacement. And so it used to be that if you had, particularly with the high net worth carriers whom I work with, if there was a hailstorm and you needed a new roof, you had a 15-year-old roof, you got a brand new roof, and they paid full replacement value. With everything that has been going on with the roofers, and now it's like everybody thinks just a small amount of hail, they deserve a brand new roof. What we are seeing is graduated settlement, so that carriers are putting into place so that if you have a 15-year-old roof, you do not get a brand new roof replaced for that. And so I'm seeing a good bit of tightening across carriers in that area.
So I agree with that as well, Maria. Now that you bring it up, we are seeing reduced roof coverage across the industry, really in the central U.S. where where the industry is experiencing more hail events, where you might not get a brand new roof, but you might get a settlement for a depreciated roof. If you have a 15-year roof, you might get half the cost to replace it. And what you might also experience on renewals is if they require a higher deductible that you may have once had, which can also help reduce the premium that you're paying. If you have a $500 deductible, moving that up to $1,000, with inflation, that might not feel as high as it did years ago, but that could also reduce premiums. And carriers are also asking insurers to increase their deductibles to help offset some of the risk retention that they have. Great question.
Okay, guys, thank you so much. That's all we have time for. Thank you to Maria, Josh, and James, and thank you to everyone that's joined us today. I hope you enjoyed the discussion as much as I did. There is a brief 2-question survey at the end of the session. If you would please provide your feedback, we would be grateful. Be sure to check your email in the coming days for a link to the recording and some bonus materials. And please have a wonderful rest of your day.
Thank you, everyone.
Thank you, everyone.
Thanks, everybody.